Most financial advice focuses on return on investment. However, for the beginner entering the precious metals market, the primary objective is not profit, it is preservation. The data from the Federal Reserve is unequivocal. The purchasing power of the fiat currency in your savings account is mathematically designed to depreciate. Today we are stripping away the marketing hype and the sales tactics often found in this industry. We are going to look at the hard numbers. We will analyze the mechanics of the spot price, calculate the true cost of premiums, and define the spread that determines your actual liquidity. This is a comprehensive data-driven introduction to allocating capital into gold and silver. On this educational report, we are establishing the foundational rules for investing in physical precious metals. Many beginners make the mistake of treating gold and silver like cryptocurrencies or tech stocks, expecting volatility and massive short-term gains. This approach is fundamentally flawed. We must view these assets through the lens of monetary history and mathematics. We will cover exactly what to buy to minimize your costs, how to identify and avoid high-premium collector traps that destroy your equity, and the specific logistical steps for purchasing and storing bullion. We will also use a spreadsheet analysis to demonstrate how the spread, the difference between what you pay and what you can sell for, works in the real world. To understand why one would allocate capital to non-yielding assets like gold or silver, we must look at the M2 money supply. When the supply of currency units expands faster than the production of goods and services, the result is inflation. However, inflation is not just prices going up, it is the value of the currency going down. According to historical data, gold functions as a hedge against this monetary debasement. It is essential to understand that gold is not necessarily going up in value. Rather, the currency you are using to measure it is going down. For example, in 1920, an ounce of gold was roughly $20. Today, it is orders of magnitude higher. The gold has not changed. It is the same atomic element. What has changed is the denominator, the US dollar. By holding physical metal, you are essentially opting out of the inflationary depreciation of your savings. You are preserving purchasing power over multi-decade timeframes. A note on silver. The data shows that silver is significantly more volatile than gold. It has industrial applications in electronics, solar panels, and medical devices, which ties its price to the business cycle. While gold is a monetary metal, silver is a hybrid. For a beginner, this means silver carries higher risk, but also higher potential percentage moves. The equation of price, spot, premium, and spread. This is the most critical section for a beginner. You must understand the math of the transaction. You never pay the spot price for physical metal. The spot price is the paper price traded on global exchanges like the COMEX. It represents a contract for 100 or 5,000 ounces. As a retail investor buying one coin, you pay the spot price plus a premium. The premium covers the cost of mining, refining, minting, distribution, and the dealer's profit margin. Your goal is to keep this premium as low as mathematically possible. Let us look at the spread. The spread is the difference between what you pay to buy the metal and what a dealer will pay you to buy it back. If you buy a gold coin for $1,100 and the dealer's buyback price is $1,280, you are immediately down $120. The spot price must rise by roughly 6% just for you to break even. This is why we avoid numismatics or collector coins. Collector coins often carry premiums of 30%, 50%, or even 100% over the melt value of the metal. From an investment standpoint, this is inefficient. You are paying for rarity, not gold. For the beginner focused on wealth preservation, the rule is simple. Buy the most ounces of metal for the lowest total cost. Product selection, coins versus bars. So, what exactly should you buy? The market offers two primary categories, sovereign minted coins and private mint bars. Sovereign coins are produced by national governments. Examples include the American Gold Eagle, the Canadian Maple Leaf, and the British Britannia. These are legal tender in their country of origin and are recognizable worldwide. The data suggests that sovereign coins generally command a slightly higher premium when you buy them, but they also command a higher buyback price when you sell. They are extremely liquid. Private mint bars, produced by companies like Pamp Suisse or Valcambi, usually have lower premiums. If you are buying large quantities, bars can be more cost-effective. However, for a beginner starting with small amounts, sovereign coins are often the superior choice due to trust and recognizability. A critical warning regarding security: there are high-quality counterfeits in the market. This brings us to a golden rule. Buy the dealer, not the metal. Never purchase precious metals from unverified sources on social media or auction sites to save a few percentage points. You should only transact with major, reputable, bullion dealers who have a long track record and test every product they sell. The risk of buying a tungsten-filled gold bar from an unknown seller outweighs any potential savings on the premium. The golden rules of investing. Based on market analysis, here are the 3 golden rules for beginner investors. Rule number 1, dollar cost averaging. Do not try to time the market. The price of gold and silver fluctuates daily. Instead of dumping your entire savings in at once, allocate a fixed amount of fiat currency every month. This smooths out your average cost basis over time and removes the emotional stress of watching daily price charts. Rule number 2, understand liquidity. Gold is money, but you cannot spend it at the grocery store. It must be converted back to fiat currency to be used. This requires a dealer. Ensure you have a local coin shop or an online dealer with a transparent buyback policy. Do not invest capital that you will need for immediate expenses next month. This is a long-term hold, typically 3 to 5 years minimum, to overcome the spread. Rule number 3, physical possession. If you are buying paper gold like an ETF, exchange-traded fund, you are introducing counterparty risk. For the purpose of insurance against financial instability, physical possession is required. If you cannot hold it, you do not own it. Finally, logistics. Once you purchase the metal, you become your own central bank. This requires security. For smaller amounts, a high-quality home safe bolted to the floor is standard practice. However, as your portfolio grows, the risk of theft increases. At a certain threshold, usually around $50,000 to $100,000 in value, the data supports using professional allocated storage in a secure vaulting facility. This incurs a storage fee, but it eliminates the risk of home invasion and ensures the asset fully. Investing in gold and silver is not about getting rich quickly. It is about ensuring you do not get poor slowly through currency devaluation. Stick to the fundamentals, low premiums, reputable dealers, and a long-term horizon. For more data-driven market reports and financial analysis, subscribe to our channel. Stay tuned for the next update. We are not a licensed financial advisor. The information in this video is for educational purposes only and should not be considered financial advice. Always do your own due diligence and consult a qualified advisor before making investment decisions.